Equity mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to episode 6 of Equity Mates. Here we have the second half of our interview with Andrew Brown. If you haven't listened to the first half, we'd encourage you to do that first. That's episode 5 of Equity Mates in your podcast feed right now. But here's episode 6, where we talk about all things investing. So I guess now maybe we'll move into some of the more current day things that you're looking at, and
absolutely.
we want to get your opinion on some things that are happening at the moment.
Yeah, absolutely.
So I guess by way of introduction to it all, maybe do you want to tell us a little bit about East 72 and what you're doing at the moment?
Yeah, East 72 is basically a company. I found a company on the NSX. There are 2 stock exchanges in Australia. There's the ASX, which is obviously the main stock market. There is like a second stock market called the National Stock Exchange of Australia. It used to be called the Newcastle Stock Exchange because it was headquartered there. Yeah. It's not anymore, it's in Sydney now. And basically it's an exchange where the compliance regime is not as strong as the ASX. So, and companies can raise smaller amounts of capital. You don't have to have as many shareholders. You don't have to publish a lot of the sort of corporate governance stuff that the ASX requires from you. But you're still subject to the Corporations Act. Okay. So I can't have accounts that are non-compliant with the Corporations Act, and so my accounts in fact are pretty much every bit as good as an ASX set of accounts. In terms of the financial accounts, they are, but it doesn't have all that other stuff that the ASX requests from you that you'd find in a really big company. So, and of course there's a lot less liquidity, in other words less share trading on the NSX, but they're actually starting to do something about that now. So the reason I did it was on the ASX you are not allowed to have non-voting shares. On the NSX you are. Right. So you can have 2 classes of shares. So people can have an economic interest in the company, but they may not have a vote. Yeah. In the case of East 72, we haven't used that yet. And it's probably unlikely we will, given that we've just raised a little bit of money from a variety of people. I found what's called a shell company. A shell company, just for your listeners, is a company that's listed on a stock market, has nothing in it. It just has its listing, that's its sole asset. And I found a company that sold its major business, which was in a subsidiary, so it's just a company that had no money, and the costs of its listing, so listing fees, having it audited, running a share registry and things like that, were being met by the directors out of their own pocket because they were looking for a business to be sold into it in exchange for its shares. And I came along, and the attraction to me of doing that was it had a significant quantum of franking credits in it. Right. Franking credits are the tax credits that are attached to dividends, which are based on obviously tax that the company has paid, and obviously make superannuation fund investing a great idea. So there were a lot of franking credits in, so my lovely wife and I ended up putting some money in, and we ended, because it was very small, we ended up with 69% of it, and we've since diluted that down by issuing shares to other people as well as putting more money into 23%. What do? We are what's called a global long-short investor, and global, we invest outside of Australia as well as in Australia. Long-short, we buy long positions, in other words we buy shares in companies, but we also short sell. In other words, we short sell companies that are overvalued in our opinion, or have fraud attached to them, which is a bit rare, where cash flow and profit don't line up, and where the company's basically going to have to take on more debt, or where we think the industry change is going to be acute and take down the business in various ways, or in some cases they're just so plainly overblown in valuation it's not funny. So we also do short sell indices, in other words, the Standard & Poor's 200, the US Standard & Poor's 500, to regulate our exposures.
Okay.
And we do use financial gearing, in other words, debt.
Yeah.
And by using futures as well, then obviously we're taking on what's called synthetic gearing, because obviously if you buy $1,000 worth of futures, you actually gain exposure to much more than that. So that's what we do, and we've done reasonably well since we restarted this thing in May last year. Our return through February is about 51%.
Wow.
Before expenses.
In this financial year.
Yes.
Yeah.
Wow.
Yeah. Just to make that clear to the listeners, that's over 50% in
absolutely.
half a financial year.
Yeah. Our second largest position had a takeover offer lobbed on it 3 weeks ago, which we were very happy about, which is a US investment company called Fortress Investment Group. So we were buying the stock at about $4.80, and the takeover offers are $8.03. So
Wow.
we're quite happy.
Yeah.
Nice.
So we were having a look at your website before this interview, and
Yes.
one thing that did catch our eye was you hold a short position in Apple.
Yes,
And now Apple's a company that most of our listeners will have obviously heard of.
absolutely.
In our podcast last week, we talked about how it has $230 billion
Yep.
sitting offshore at the moment.
In cash.
So
Yeah.
in cash. So
Yep.
why the short position?
Okay. Couple of reasons. Apple's had a fantastic run as a stock, okay, and has moved to a stage where I think it is more than fairly valued, okay. Now the reason I say that is in the past, and I'll come on to why the past is different to the future. If you look in the past, every company that relied on a device as its key entree, near as damn it went broke.
Yeah.
BlackBerry, Nokia,
Yeah.
okay,
I mean,
are two really good examples. Now, the bull or positive case for Apple is that devices are doing more than that, because devices are an entree to an ecosystem whereby they create an annuity income stream. Okay, an annuity income stream is basically something like a monthly subscription. Okay, so I believe that Apple's growth over the past 12 to 18 months has been aided by Samsung's woes, even though, please don't forget, it wasn't the Samsung phone, not the core Galaxy 7 phone, it was the Galaxy 7 Note, which is a bigger sort of version of the phone, that was the problem child. But it quite clearly sullied Samsung's brand. If you don't think that Samsung are not going to come out all guns blazing with the Samsung Galaxy 8, you must live in another galaxy. Okay, so I think it's going to really start to threaten Apple more. Apple are being threatened by all kinds of Chinese, not knockoffs, but Chinese devices. And don't forget, a lot of Apple's growth's been in China because of the brand awareness. Now the other side to it is the ecosystem. Apple is really quite a closed system, as you well know. You use iOS on a laptop, you use iOS on an Apple phone, and so of course, you then go into iCloud as well. Okay, whereas there are many more devices that are basically in the Android sphere. And don't forget who created Android. The mighty G, Google. And basically, it's my contention that people will gradually find that the Google sphere, if you want to call it that, and the Android sphere, and whether it's just using G drives, and using other forms of cloud, are actually is gradually going to basically dull Apple's growth down. And as far as I can see, everybody in the world that's bullish about Apple seems to own the stock. Now including the man who says he doesn't understand technology, Mr. Warren E. Buffett from Omaha, Nebraska. So basically, my view is, my view is that all that's sort of pretty well in the price. And that Apple's real growth has come when they've introduced sort of just knock you out product.
Yeah.
The original iPod, which changed the nature of music streaming, or changed the nature of music full stop. The iPhone, which obviously was really the starting point to the devices we all have now.
Yeah.
Is there more of that to come? Well, we can't categorically ever say no, but basically I think it's going to be a lot harder for them to create new things. And you've seen that because their new innovations in recent years have tended to be a bit more of a struggle.
Yeah,
The Apple
definitely.
Watch,
Been
most
lucky.
obviously.
Yeah.
And tablet, I love tablets, but I've got to accept that I'm probably in a minority.
Mm.
So there's been a lot of chatter sort of at the moment about a lot of markets being overvalued,
Yes.
both domestically
Yep.
and overseas.
Yep.
And you being an investor who loves an undervalued market,
Yep.
where does that sort of hold you at the moment in terms of cash position for E72 and also your activity in trading?
Okay. We have, despite, basically we've pretty much hedged all our capital, so we actually have pretty much a zero exposure to markets. And when I say a zero net exposure to markets, which means that the money that we have invested long, in other words, the shares that we own, okay, we've actually offset that with short positions in the index or other shares. Now, to give you an idea, when Brexit happened towards the end of June, East 72 is in its infancy, so we had about 140% exposure. And so what that meant is that our net exposure, we actually had our capital and borrowed 40% more than it because shares were cheap. If you go back, and everybody talks about Brexit, go back a year. In fact, go back to the 11th of February 2016, and you'll find that coincided with markets around the world roughly having fallen 15% over the space of 6 weeks. Okay, that's a fair correction by any stretch of the imagination, and what that did was it left some shares extraordinarily cheap on any basis. Now, to give you an idea, in my private accounts I had 4 times gearing. In other words, I took $1 of capital and then had another $3 of debt piled on top of it, because I was the proverbial kid in a candy shop. Okay, you were able to buy things like, okay, and this is where value, and I'll give you an idea. I was staying up all night, like twice a week, okay, buying Bank of America stock at $11.80. It's currently $25. Okay, and $11.80 was like a 30% plus discount to its book value. I was buying Morgan Stanley stock at 23, and their book value is sort of like 30 plus. You could have bought what some people think is the most evil company in the world. I love it. Goldman Sachs. You could have bought those below net tangible asset backing. In other words, all these people that do all this amazing work for Goldman's, you're getting them for nothing. And there were heaps of examples around the world where you could buy investment companies at 30+% discounts to relatively easily realisable net asset backing. Why? Because people say, "Oh, China's slowing, the world's ending. Oil was at $20 odd. Don't ever forget, markets go, mad at times. People go absolutely crazy, but they go crazy both ways. They go crazy thinking markets are never going to stop going up, and they also go crazy thinking markets are never going to stop going down. And so, all we'll say is the Standard & Poor's 200 in Australia last February was at 4,600. It's now kind of 5,750. Okay. The Dow Jones is up somewhere in the order of 35% plus since then in a year. Well, if I deliver you 35% in 1 year, from a level which, don't forget, wasn't, whilst the market had come off 15%, what you've noticed is I was buying cheap financial stocks. If you have a look at Amazon around that time, you'll find it's about the same price it was a year ago. Okay, it's certain parts of the market that were very, very cheap, and so that's one of the reasons my returns have been really good. Is that I've captured at least a good part of that in E72, and the returns in my private accounts are obviously pretty similar.
So you don't think there's that much undervalue?
No, it's finding it. It is a lot harder to get it, Bryce. It's a lot harder to find it. I have to say, at the peak of any bull market, there's always some undervalued shares, and at the bottom of every bear market, there's still some overvalued shares. But it's getting a lot harder to find, really butt-kicking value in my eyes. I can find some, and I might even share one or two things with you if you want.
Yeah, why not?
Yeah.
So is the plan to sit and wait then?
No, the plan is basically to try and, if markets do correct, I mean, I'm hoping to make money out of securities that I think are overpriced, and make money as they come down. I do obviously have a core holding of some stocks. I don't want to give anybody the impression I sit there trading frantically day in, day out, because I don't. But certainly, I'm holding on to my core stocks, which, I still have, a number that I think have got, decent upside. But I've done a lot of hedging because I think overall, when you look at the overall market indices, I think that they're too fully priced. When you aggregate up the values or the earnings of each of the companies that make up those indices.
Interesting. Yeah. Well, so I guess something that maybe in terms of this is off the question, but just for a bit of a more basic understanding, what would be some advice for people who don't really have the option to hedge as such in a market like this? What would be some advice?
In a market like this where you don't have the scope to hedge, I mean, first of all, don't get panicked out of the market. Just because Andrew Brown thinks market indices are fully valued, if you've got a good portfolio of stocks, then if you're doing what I've said to do, keep interrogating the thesis, okay, then there's no change to that, okay. And so if you believe that your securities are still, reasonably undervalued, they've got upside, the management keep doing the right things, then don't get panicked out of them. And of course, what you should do is, if the market were to fall 20% and your shares were to fall 20%, then, obviously what you try and do, if that takes them to well under what you think they're worth, then you buy some more, okay, or across your portfolio. Remember Warren Buffett's advice, he's a little bit extreme, but basically, you should be, if the stock market were to close for 10 years, it shouldn't worry you, because you have a claim or a stake in a really good business. So I can assure you, one of the things that really spooks young investors is the fact that there is a market. Now, imagine you owned a house and every day I came along and gave you a price for your house. What would you do? You would be prone to transacting. Yeah? Yeah. That's the quote on your website. In the short term the market's a voting machine, in the long term it's a weighing machine. Okay. And so you mustn't get panicked into or out of stocks just because there's a quoted price for them every day, particularly if you're a small investor. Focus on the company, focus on why you're there. Is that still happening? And then if you get it, if you've got a bit of spare cash and you've got a chance to buy more at a very cheap price because markets come down, do it. Let's just put it this way. I don't get excited by markets going up and up and up. I get really excited by markets going down and down and down. And all I'll say to you is, if the price of toilet paper in Woolworths and Coles was $5 a roll, okay, would you be running off to buy it? Or would you get really excited when the price of toilet paper at Woolworths and Coles was $5 for a 50-pack? You want it to be $5 for a 50-pack. Yeah. And yet it's crazy. You find so many people, so many individual investors get really excited and want to buy into the market when it's going up and up and up. Yeah. And that's, it's FOMO, fear of missing out. Okay. Whereas what they should be doing is, when they see in the paper market crashing and everything else, that's when they should be, getting the calculators and the computers out and working out, what do I want to buy? Yeah. Because that's when you get a bargain.
Yeah. You're up, Ren.
So, something that Bryce and I are interested in, and that we both hold some stocks in, and we know from your background that you have some experience in is the agricultural sector.
Sure.
And so you, for 13 years, were a director for the Australian Rural
Capital. Yep.
Australian Rural Capital. Yeah.
Yep.
What do you think the prospects are for Australian agriculture going forward?
Okay. It was only part of that period of time the company focused on agri investing, but the prospects are really interesting. You've got to remember, I mean, like, agriculture is just, it's a multitude of different industries. Okay, not only different commodities and products. So I think it's a fair comment to make that, the global outlook for sugar might be a little bit different to the global outlook for beef, which will be a bit different to the global output for wheat and grains and things like that. So that's the first thing. You don't have to just invest in the land or the grower. One of the things in Australian Rural Capital is we have a big investment in a piece of what we call agri-structure, which is the infrastructure behind agriculture. So Australian Rural Capital owned 11.5% of a company called Namoi Cotton Cooperative, and Namoi Cotton is the biggest cotton ginner in Australia. So what drives Namoi is not the cotton price. What drives Namoi is the volume of cotton it goes through its gins. So if there's a drought, don't get much cotton through. If the weather's been good, then the cotton crop's really good and it gins a whole lot of stuff and makes a bunch of money. So you've got to really focus on agriculture, not only in the different areas. So the beef price has recently been extraordinarily high and is probably going to start coming back. You might ask the question, does sugar have a major health issue over it? Question mark, in the long term. And then, certainly grains and certainly protein, generally we know that there's basically a global shortage. And so Australia as a gross generalisation is really well placed because we grow this stuff well, we grow it relatively cheaply, and everything else. Where a lot of the gains I think are to be made, and unfortunately there are not very many investments on the stock exchange like this, is in the next step down, which is the processing and the infrastructure. So companies like GrainCorp, having a bonanza, this year. Namoi, as we've said, Namoi have got a very specific restructuring taking place to free up your share register. And try to look for companies like that are either processors or involved in the infrastructure. Unfortunately, that might have taken you into something like the Murray-Goulburn Cooperative, which would have been a bit of a disaster if it did. Yeah. But it's not just about growing, because you've got to remember, basically, the value of land goes up over time, but it tends to be quite slow. And obviously, if you were a farmer, imagine you just invested in the farmer, then the value of the land's okay over time, but you do unfortunately get feast and famine, with droughts and everything else. And they're really, there's a couple of stocks, Australian Agriculture Company and Elders, and certainly Elders has regenerated itself quite brilliantly over the past 2 or 3 years. To service the sector. There are some others like Rural Co as well, which supply, they're basically big suppliers of, fertiliser and everything else. Yeah. So it tells you, it's not just the sort of core thing, it's kind of like who provides the services to it, and if agri is going to grow, are they going to grow with it?
So with the Australian Agricultural Company, they recently vertically integrated and now own everything from growing the cattle to exporting the cattle. Yeah. Do you think that those vertically integrated companies are a good way to get exposure to the processing, or?
Depending on where they're integrated, typically yes, because there should be some value add down the chain. The issue with the Australian Agricultural Company is basically it's a control company. There's basically a UK/Bermudan-based guy, Joe Lewis, actually effectively controls Australian Agricultural Company. So you've got to be satisfied that you're happy with Joe's treatment of minority shareholders.
What do you think of Joe?
Joe is extraordinarily astute, except in one respect, which of course he's one of the main owners of Tottenham Hotspur Football Club, in which case he must have gone off the rails. But no, they were very smart. So, but you've got to ride along with him, and that may not be the easiest ride. Let's put it that way. Yeah. I have positions in 2 companies in the agri space. One is Namoi, obviously. And the other one is one of the most horrendous floats of not last year, the year before, called Wellard, Wellard, and Wellard are by far and away the biggest transporter of live sheep and cattle from Australia to the rest of the world. So if you don't have an ethical problem with
Is
that,
it live exports?
it
or-
is live exports.
Okay,
They
yeah,
provide the ships. They have five boats,
Yeah.
and these things are. Give you an idea. The latest boat that's in the course of commissioning costs $90 million.
Wow.
So they're not.
And it's a pretty specialised.
It's a
industry.
very specialised
So
industry.
Do they have a pretty high market share in that?
Yes, they do. But I mean, the problem was the stock was floated at $1.80, and it recently got as low as 17 cents.
Okay.
And then the last of the stock overhang, a group had about 8% of it that they were trying to sell, and Robert Holmes, of course, son, has actually bought that 8%. So the stock's now 25, but relative to the $1.80 float, and the company's in breach of its banking covenants at the moment as well. But it's an industry that's very volatile. You'd all be familiar with the fact that Indonesia does keep turning the tap on and off to live cattle exports from Australia for whatever reason.
Along the lines of volatility, do you think it's an industry that is also susceptible to disruption?
It's not easy to disrupt, to be quite blunt, in the way that, we spoke about the cab industry being disrupted and everything else. It's pretty difficult to disrupt the agricultural industry, because at the end of the day, you've actually got to grow the stuff or wean the animal.
An Uber for live cattle.
Yeah, well, I mean,
there's
you hear of
There's
the Japanese growing hydro lettuce and all that sort of stuff.
Yeah,
so you think, is that something that we're looking at?
If you think about it, I mean, one of the great disruptions in agriculture has actually occurred in Australia in aquaculture. Because obviously 3 of the largest companies in the world in salmon, are all based not just in Australia, but in Tasmania. 2 of them are listed: Huon, which is the smaller one, and Tassal, which is the bigger one. I mean, they've obviously created this huge market for salmon, and I mean that's disruption, because it's basically farmed salmon, which some people have issues with, and there are some issues if you watch the ABC Four Corners program about the waste and everything else from that.
Right.
But they're the kind of things. I mean, technology plays a role in agriculture. I mean, just merely tracking of animals, and things like that. So technology's got a huge role and can certainly make things a lot more efficient than it has been or is. But in terms of actually, the sort of an Uber or coming in, no.
Yeah, technology is going to, according to Monsanto at least, it's going to play a huge role in the next iteration of agriculture.
Yes, it will.
The Internet of Things is going to change.
It will change. It's a matter of how you use it in agriculture, and please don't forget, Monsanto obviously are the world's preeminent company genetic modification.
Yeah.
And certainly where I go, there's a big move back to organic. And I know organic and GM are not the same. In a sense, you can have the same, because it's a matter of what strain you grow. But it's sort of starting to become an interesting issue.
Yeah. It is.
Well, we've covered the last question, which was why you decided to go otherwise than
absolutely.
Other than the ASX.
Do you want to speak? I think you probably wanted some. I don't give stock tips.
I was just going to say we should finish with the bit burning desire. If you were to
absolutely just to give you an idea. Obviously, because I've done this for a long time, I mean, I've had friends sort of ask for stock tips, and I've never given them any stock tips. But what we've done instead is we've asked friends to pool their money with mine, and then obviously they get the benefit of the whole portfolio. Okay, so with that huge caveat, then the type of things, I mean, it's sort of public knowledge, because we're a public company or E72 is a public company of the sort of some of the sort of positions we have. But just to give you a little bit of sort of out of the box thinking, and I'll restrict this to Australian companies, even though it's actually a bit easier to buy overseas companies than you think. But we'll stick to Australian companies in this. One of the companies I've recently been buying is McGrath. okay, on McGrath Holdings, which is the
Really?
real estate agent. McGrath was floated last year at above $2 a share, and the current share price is 66 cents.
Yeah. It was such a bad float that he had to drop out of Shark Tank.
It was, yes.
Getting slammed at the moment.
Yeah.
Well, it's why is that? And people maybe bought into it on two counts. That first of all, John McGrath is an extremely talented individual and has obviously driven the company from its commencement. But secondly, the property market's going up. The property market going up has next to no influence on McGrath. It has a secondary influence on them, but the primary influence on McGrath is the number of houses they sell for other people, or units. So listings, and you'd be well aware that listing volumes have absolutely collapsed until recently, where they're showing signs of picking up. And so it's that problem that McGrath had. Now, there's usually a relationship between listings and price. Because this particular property market's been so absurd, what you had masses of listings until about the sort of middle to late 2015, and then listings fell off in 2016. And of course, McGrath floated right at the end of 2015. Well done, John. So what I'm hoping for is that basically there'll be more listings, that the market's going to free up a bit. And so if that happens, and because McGrath are expanding away from the areas that some of your audience will understand, like the eastern suburbs of Sydney, and they're going to a much wider area, so they're actually growing the business. They're becoming less reliant on things, and they've got a mixture of both company branches and franchises. I think that basically, the shares are relatively cheap versus what they're capable of earning in a property market that will be more normalised once they've grown a little bit. So in a sense, they're actually, if you believe that the property market's disgustingly overvalued and is going to collapse and cause mayhem, well, it's a pretty good play on that, because they're going to get a whole lot of distressed properties to sell. One hopes. So I think that's quite interesting. I think that's quite interesting. I do stress on all these things. You need to take sort of 2 to 5 year views on these things, and if you happen to get lucky before then, well, that's luck. I think one of the other interesting stocks, because I think it's trading way below what it's worth, is News Corporation.
Okay.
News Corp is it's a great example of why I do what I do, which is break companies down into their individual bits. It's the largest shareholder, owns 62% of realestate.com. It owns 80% of a thing in the US called Move. It owns half of Foxtel. It owns all of Fox Sports. If you take the value of News' stake in REA Group, a value of Move, a sensible value of Fox Sports, a sensible value of its half share in Foxtel, plus its 2 shareholdings in Australian provincial newspapers, or APN and Seek Asia, it's my considered opinion that you get the rest of News Corporation for nothing. And the rest of News Corporation is HarperCollins Books and all the newspaper and related digital business, which the newspapers are the Wall Street Journal, the New York Post, Barron's, which is the financial thing, that well-known organ of public record of the Daily Telegraph in Sydney, the Australian, and of course the Times and the Sun in the UK, amongst other things. And if you're in Brisbane listening to this, that august publication, the Courier Mail. So I think the stock's relatively cheap. Obviously Rupert Murdoch's not getting any younger, but both his sons are now in the business. And it's got no debt. It's got net cash.
Yeah.
Okay. So it's not going out of business anytime soon, like it nearly did in the 1990s. So I think the stock's really, really cheap, and I acknowledge that some of the industries and businesses it's in are not growing at all. But some of they're very, very good at eking a return out of those. So I think that stock's pretty cheap.
And I guess that's again illustrates your philosophy. Like you're not worrying about their growth down the line. Like if it's a good value investment, then it's
that's
good
right.
Value, yeah.
Probably the third. If I give 3 stocks, I think that's
Go for it.
really
Give us as many as you like.
Build us a portfolio.
Yeah.
The third one I think is really interesting again because it sort of exhibits the sort of style that I like to exhibit. The company's called PM Capital Global Opportunities Fund. The stock code is PGF. It's a what's called a listed investment company, so it's a company that invests in other companies. It's basically it's about a $400 million listed investment company. It was set up in 2014, I think it was. It's run by PM Capital. PM is Paul Moore. Paul's a very, very smart guy. He was part of the amazing group of people that were at Bankers Trust, or BT, in the late 1980s, and those people brought you Kerr Nielsen, who's Platinum, Chris Corrigan, who obviously was heavily involved in the stevedoring dispute, and many others. So Paul's portfolio it's a global portfolio. It's chock full of global banks, which I still think are very cheap. It's chock full of global alternative asset managers, in other words, people that manage things like private equity and hedge funds and things like that. And you can actually buy this. It has a net tangible asset backing before its tax liabilities of about $1.17 a share, and you can buy it for about 96 cents at the moment.
Wow.
So it's about it's roughly about a 17+% discount to its pre-tax NTA. That's pretty wide by the standards of Australian listed investment companies. Why is it a discount? Well, its first year was pretty ordinary. It just got off to a pretty bad start. But Paul's a long-term investor. He has an exceptional track record, and so my figuring is that I can buy a portfolio of stocks that, in my opinion, I love. At 17% cheaper than their accumulated public market price. So why wouldn't I?
Yeah.
So I think that's really good. I would love to see Paul buying their own shares back. I think that would be a great use of their money.
Yeah.
And I hope that they will look to do that and close down the discount. So I think that, particularly if you don't have a lot of money and you don't feel inclined to want to just dip your toes yet into individual companies, if you want something that's going to reflect global stock markets and particularly Paul's view of them, then that's quite a nice investment at the cheapest price relative to the cheapest share price relative to the net tangible asset backing that's been since it listed.
Great.
Well, 3 very diverse, different businesses.
Yeah, absolutely. Yeah. So you got to remember, News Corp is a bit influenced by real estate.
Yeah, true.
So I hope. I mean, the idea behind real estate is, and I hope. I mean, some of the examples I've given you with, particularly cab charge, which I think was the ultimate. But think outside the box a bit. Think about how you can get exposures to things in a slightly different way. Is always a bit of a it means that your thought process is a bit thorough, and it's a bit more intellectual than the average. Oh, it's good. There's a lot of people outside the shop. It's going up.
Yeah,
So,
yeah.
Well, Andrew, I think we'll wrap it up there.
No worries.
Yeah.
Thanks for your time.
No, pleasure, guys, and seriously, good luck with everything. I think it's really important. I mean, one of the biggest things missing in Australia is advice. And as we well know, the advice given by a number of major supposedly financial advisory groups is pretty ordinary. And the more work you can do yourself, so that if you do have a financial planner or advisor, you can quiz them and you can interrogate them better. And of course, the more work you can do yourself and invest your own money, because it's so much easier to do it and so much cheaper to do it than it's ever been, the better. And anything that adds to that is good. And anything that adds to that for particularly younger people, it's really important, because don't forget, if you start at age 24, then you've got a year's earnings by the time you're 25, and as Keynes is reputed to have said, but nobody can actually find it anywhere. Of course, the 8th wonder of the world is compound interest.
Well, yeah, I mean, you've certainly given us a lot of advice for people that are starting out all the way through to expert level.
Absolutely.
So I really appreciate your time.
No problems at all. And good luck with everything. And anytime you want to come back, I'm more than happy.
Thank you.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.